The market loves traders who feel like they have to show up every day, because the market doesn't offer opportunities every day, but it does offer movement every day. And an untrained eye can't tell the difference. So a trader will show up every day and treat every trade the same, not realizing that they're slowly diluting their edge and giving all their gains back to the market. Because we've all been led to believe that motion equals progress. That if you're working hard, even if you don't see results yet, you're heading in the right direction. And this is absolutely not the case. The thing with trading is that effort doesn't add up. You don't get better just by taking trades and being in the market more often. It's more like digging for gold. If you dig a hole, fill it back in, and dig the same hole again every day, you might feel productive, but you're not getting any closer to the gold. Progress only comes from focused effort in the right conditions. That starts with trading the good days and avoiding the wrong ones. So in this video, I'll show you exactly how to know if a day is even worth trading right from the start, so your profits don't get erased and actually start compounding. And just a quick disclaimer, none of this is financial advice. I'm just showing you what works for me. If you choose to use it, do it responsibly and size correctly. Here's what actually happens for most traders. At some point, trading stops being about opportunity and becomes a routine instead. So you're used to waking up, opening the charts, taking a trade, and then repeating that same process the next day. You get used to this flow at a certain point, especially if you have a win streak or multiple consistent days. It's kind of like your brain adapts to it and subconsciously expects it to keep happening. And of course, what happens is, as soon as you get comfortable with this, the market switches up on you. You'll either get a few days of zero action or take some losses. That's when your routine suddenly gets thrown off. You start scanning harder, and you start dropping standards. Your brain is telling you that there's something there and you just need to find it. You click just to feel involved and you take trades to justify screen time. This is the part of trading almost nobody prepares you for. Because if your default mode is participation, you'll always find a reason to trade, even when you shouldn't. That's why psychology alone doesn't fix this. You can know all of this intellectually and still fall into the same pattern. Because in the moment, routine and habit will always override logic. Which is why, for me, the solution wasn't trying to be more disciplined. Because you're just fighting against the current. It was building a process that decides for me whether trading is even allowed. That's what finally stopped me from destroying my accounts every day. So, how do we decide, early, whether the day is even worth trading? Well, the urge to trade every day comes from the fact that you don't have a clear understanding of the day's context. You know that some days are definitely worth trading, while other days are definitely not worth trading, but you can't exactly say why. If you could see the end result of every day beforehand, you'd be able to tell right away that it wasn't a day worth trading. You could explain the reasons clearly now that you see it. But that's just hindsight, and it won't help us while we're actually trading. We need to figure out how to know before we trade so that we actually benefit. The key to this is market structure. Most traders ignore or straight up trade against market structure, despite it being one of the only reliable things about trading. You can't predict the market in any way. That's a fool's game. But you absolutely can stack probabilities in your favor and only trade when the structure aligns with your edge. Because your edge comes from filtering out the conditions where your strategy statistically underperforms. So this is how we do it in the market. The first thing we do, of course, is have our supply and demand levels mapped out. If you want to know how this is done, I'll link a video right now explaining how. These levels are the key to understanding market structure. Because here's the thing, if you're not careful, you'll overanalyze market structure and become paralyzed. You'll never end up taking a trade. Market structure is the overall framework of price movement. It tells us the current direction of the market and where the price is likely to flow next. Supply and demand levels illustrate that flow. The price will simply move from one level to the other and repeat this process over and over. When it comes to trading these levels, we only have one of two choices, of course. The price will either return to the level it just came from or break out to the next level, and knowing this difference will be absolutely critical for us, because the market will never look exactly the same twice. Every day is different, and just as unpredictable. But all that really matters is knowing what phase the market is in. Because the market only has three phases. The price will either be in an uptrend, downtrend, or range. When the market is in an uptrend or a downtrend, it doesn't mean we can predict the price's exact movement, but we have a better idea of the overall direction. In other words, the trend has some predictive power and can give us an edge over time. When the market is in a range, this all goes out the window. The price can chop you out repeatedly, and you have no sense of direction. You can't even predict that it'll stay within the range, because the range could just move or expand unpredictably. The best move in a range is not to trade at all. The only phases we want to trade are uptrend or downtrend, and we also want to trade in a specific way during those phases. When it comes to trading in a trend, we have two main options. We can either buy the dip and sell the rip, also known as a pullback, or we could trade the breakout. Pullbacks are a valid trade, even a great trade, but the problem is they're still technically inside a range. So if the market looks like it's in an uptrend and pulls back, well, it could be an early entry into a trend, or it could continue chopping until it decides a direction. We're less certain about what it'll do. But in the case of a breakout, the price is telling us that it wants to break structure. This makes it more likely to follow through because it's officially breaking structure, and it's taking out long-term buyers and sellers at the edges, which gives legitimate fuel and volume to continue pushing the price in that direction. I have a whole video where I go into depth on trading breakouts, so I'll link that here now. The right breakout trades are simple to spot and trade, which is why I love trading them. But the harder part is, how do we avoid trading everything in between and avoid that itch and routine to trade? Well, now that we know we only need to trade breakouts, it becomes simple. We never want to take a trade at the opening level. If we zoom out here, we see that the price is near the upper part of a range. Now remember, we don't want to be trading inside the range. Even if the price looks like it's in an uptrend short term, the overall structure is more important. We don't want to be buying pullbacks or catching any knives. The move here would be to wait for a break to the next level, then go long. That would confirm a break of the range and give us momentum to continue higher. Now, when it comes to looking for a short, we also want to be cautious. We're looking for a breakout here as well, but there's also some sharp market structure to the downside. We can either patiently wait for this level to firmly break, or we could even wait for the next level break if we want to be extra safe. This will confirm a break of the range to the downside and will give us the breakout we're looking for. The point of both of these trades is to make sure the price actually breaks out of the range and build some structure that would validate the beginning of a trend and indicate a continuation. So we set our alerts and wait for the price to hit one of them. It's very important that we pay zero attention to what the price does in between. This will completely stop us from engaging with the market and forcing trades when we don't need to. Because even the best traders could be tempted by price action. We don't want to force discipline and willpower when we don't have to. So we physically stop ourselves from interfering until we absolutely have to. Now, here we see that the price never manages to break into the upper level or build any sort of uptrend structure. We have this expanding range here before it finally drops to the lower level. Now, this is why you never want to trade the opening level. If you would have even attempted to trade this, it would have been a disaster. Multiple stop-outs at the very least. Then we bounced off this level and rebalanced into the range. So our trading day here would have been setting two alerts, and then neither of them getting hit. So we would have never even opened the chart. Or if one of them did get hit, we would have opened our chart and seen a reversal back into the range. So there would have been no trades today regardless. And the point is, you want to make this as effortless as possible. There are entire weeks where the market offers no trades and no quality moves. Instead of watching the entire time and stressing about every candle, just set your alerts and sit back. The market has to come to you, not the other way around. That's what this entire approach is really about. Not being more aggressive or more disciplined, but removing the need to constantly make decisions in the first place. So instead of asking, how do I trade better? The real question becomes, is today even worth trading at all? When the answer is no, you step away, and that's a win. Because protecting your edge is how you stay in the game long enough for the good days to do the heavy lifting. And if you want help actually applying this, reading structure, knowing when not to trade and sticking to a clean process, that's what I walk traders through inside my LCE mentorship. If you're interested, click the link below and be sure to like, subscribe, and turn on notifications. I'll see you in the next one.